Yo, what's going on, guys? It's back, and today we had a brand new video with a looming recession on the line. We have data that just shows us that we might actually have this recession coming. And what does it actually mean? How's it going to affect stock prices, crypto, Bitcoin, all these assets? And what can you do during a recession for investing? So, the sign we just got is called the yield curve inversion, which basically means short-term debt is worth more or returning more than long-term debt in the bond world. And when this happens, it's usually a leading indicator that the recession is coming, and we'll see, how long it lasts or however long it can affect. But it's usually a pretty good indicator as to the recession actually coming. We can see it on this chart right here. This is from the St. Louis Fed, so all their data is pretty good data. And we can see this inversion basically means when you go under zero. So this chart is the 10-year minus the 2-year. So if the 2-year is returning more than the 10-year, then you get zero or negative, which means short-term debt is better than long-term debt for return. Not really what you want to see, not a healthy thing for a market, but you can see right here in 2019, we had this yield curve inversion, went to zero here, and then we had a recession here in 2020. This is one of the signs where we see it coming here and kind of bounce back up. And a lot of people question, would we have a recession if it wasn't for the pandemic and all of that, which is a normal thing to look at. But if we zoom this out all the way and just kind of take a look at all the times when it's gone down to zero here. So even starting, we know this one we just looked at before in 2008, 2007, the financial crisis. We see this leading here, went to zero, was around zero for a long time, majority of the time below zero in the negatives. And you see it skyrocket when this recession starts. This has been the story with all of them. We see it here. This time you see it come down, touch it, but stay above, and no recession here. But then it plunges below and forces a recession right here. And this was the dot-com bubble around that era. And you can even go back even further. This section below it, leading it into a recession. And then here you get a little mixy of really confusing data where it stays below. We have a massive recession and it just quickly does a lot of things here. So, but we can see that usually when it goes to zero or goes under zero, we have a recession coming as a leading indicator. Now, the question would be, how long do we have to stay here? Does it have to stay below zero for a extended period of time? And is it actually going to lead to a recession? Because we know this one right here in the latest one, 2019, where we kind of came down, went to zero, but bounced off it. People would say we weren't heading for a recession without the pandemic. So, are we looking at something similar here where we go to zero, maybe stay here for a little bit, but come back up pretty quickly and have it have a minimal effect on the economy and recession as a whole? Who knows? But even if we look at the S&P 500 here for investing really quickly, if we go back to these kinds of tops of 2000 to 2002, this recession down 37%, but then you get to ride it up 67%, somewhere around there, before the 2008 recession, which went down 40%. But then this one, you would have had a giant wave up of 352%. And then the obviously pandemic one here, but it was super quick, and that one went down something like 25%, but you would have had an 80 to 90% recovery. Crazy numbers. So the key from looking at this is to stay invested in the market and try and not to move money out, even though, short term it can be bad, but over a longer period of time, the returns heavily outweigh the downside. And honestly, during a recession is the best time to be buying assets. That's when they're going to be on sale. We can see this from some of these charts right here, where you can see during a recession, even these, this is from, June 2020 goes up to there. But during a recession, the stock market, which is this dark blue, it still has a positive return. Government bonds, investment grade bonds, high yield bonds. So tons of bonds in here. But obviously during recession, High yield bonds do the best because bonds are extremely trustworthy. You basically guarantee your return. You're not gonna have to worry about it at all. In the stock market, you got a lot of risk there. But during the recovery, all of a sudden the stock market takes off and has huge outsized returns compared to what bonds are because it's no longer risky. You don't have to worry about recessions after they're already gone and we're in recovery mode. Then that's when you can make a ton of money. So, but during a recession, stocks and equities, assets, at this point, crypto and Bitcoin can go heavily on sale. They don't even have to, but if they go on sale, like we've seen the past few months in this year, being negative returns for both Bitcoin and the stock market, then you could use this time to buy those assets at great prices and ride the wave up when there's a recovery. We can also see here this just kind of pointing out recessions and bear markets. You usually see a bear market lead a recession. So a bear market happens before the recession does, which you can see like earlier here. These top orange are bear markets, the bottom blue are recessions. You see it goes into bear market just before the recession starts. Same here, goes into bear market before a recession, and that's what we're having right now. We did technically go into a bear market for a little bit, I think last week, but I don't think anymore we're in bear market territory, which is a 20% drawdown in the stock market. You can see all of these. I mean, there's a period here, bear market leads recession, bear market leads recession, bear market no recession, and no bear market recession. So it can happen both ways. But it's much more likely you have a bear market leading a recession than obviously any of the other ones. So it can happen either way. But are we looking more like this right here, where it was bear market, but then the stock market super recovered and the recession didn't really have a big effect on the market? That is something we could easily be going into, where a recession could come after the stocks have already suffered, after people have already priced in this. A recession happens, and then the stock market does great, but the economy and everyday consumers get hit the hardest, and that's where the struggles are, not in financial markets. So with the yield curve inversion being a leading indicator for a recession looming, are we staring down the barrel of a recession coming? And are we actually already out of it for the stocks? As the most part, we've saw huge drawdowns for the past in this entire year so far. And if we get a recession, the worst of the news is probably priced in and expected already. So the time to be buying assets would be during that time, even though it seems a little counterintuitive. That's actually what makes it the most important time to be buying, when things are on sale and you live up to the other quote of Warren Buffett's quote there being, be fearful when people are greedy, and greedy when people are fearful. A lot of people quote the second one, being greedy and stuff, but don't actually kind of live up to it if there's extreme fear in markets. So we'll see how recession affects, stocks and crypto and Bitcoin. It'll be interesting to see how Bitcoin, being so mainstream that it is now, how it gets affected, if it gets affected, and what its volatility goes to during a time like that. But only time will tell. And historically, it's always been a good buying time during recession. So as always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. And I'll see you guys in my next video.